Just to give you a bit of background before we go into the deeper details, we understood that the risk increase the return, right? And by using a portfolio method, we can eliminate the unsystematic risk, but we cannot eliminate the systematic risk. Those risks are still there, correct? So those are the two basic concepts we learned in the previous two slides. Even though it's very simple concept, but it took a bit of time to understand because there is a lot of background information that need to be given. Now for cost of capital, we need to understand the typical balance sheet. So the typical balance sheet looks like this, right? There are current assets, there are long-term assets. On the liability side, there is a debt, preferred stock, and equity. Now all of these three comes at a price. So what is the price of debt? The equity is you have to pay a dividend, but it's not compulsory, right? So usually if you say in that sense, and so that is the return, right? And now look at the risk. So debt has a risk. Who has the highest risk in debt, preferred stock, and equity? Equity has the highest risk, right? Debt has the lowest risk because they are the first one to get paid if in case of any problem, right? Then the next one is preferred stock, and the last is the equity stock. In that sense, the debt holder cannot expect the highest return, right? So that's why they are expecting a lower return because they are riskless. Preferred stock, they get higher than debt but less than equity because they carry a slight risk only. The equity shareholders, since they don't get any fixed income, they carry the highest risk. So that's why they demand the highest returns as well. Now, even if you say that you don't have to pay dividend to the equity shareholders, the equity shareholders still expect something, right? They still expect the share price increase in the price, or at least dividend payments to some extent, or increase in the earning price share. So they still expect high return. Now their return is highest because they are the one who carry the highest return. So how to determine that, we will look at it now. So normally there are two type of capital structures. One is 100% equity, one is more on equity, less on debt, which is Apple. Facebook is 100% debt free. Apple is slightly with a debt, maybe around 3 or 4%. And then there are some other companies where their equity is less and debt is more, or sometimes debt is higher than the equity, right? So these are kind of mixed capital structure. So it depends on the industry requirements, how much capital intensive they are, and what are the fixed asset requirements into them. That determine the capital structure of the company. Okay. So the weighted average cost of capital usually is the average of all the three sources that we have discussed, right? So we have discussed we need to calculate first the weight of our capital in terms of debt and equity, and what are the based on the market value of balance sheet. We don't look at the book value of balance sheet to calculate the weighted average cost of capital. So you have to remember that always whenever there will be an assignment based on calculating the weighted average cost of capital, so you have to use the market value of the balance sheet. You have to use the market value of the debt, market value of the equity as well to calculate the weighted average cost of capital. You cannot use the book value. So the market value of the weighted average cost of capital is market value of equity into the cost of capital plus market value of debt into the cost of debt. Then that will give you the weighted average cost of capital for your company. Now the question is, the weighted average cost of capital will be same or different for all the companies. So the weighted average cost of capital, if you look at previous one where we have different weights, let's say the equity should expect 20% return and debt expect 10. So in this case, the weighted average cost of capital for Facebook should be very high, right? Because it's all equity, 20%, correct? My question is, let's say if the equity expect 20% return and debt expect 10% return, right? So in this case, now you will see the three capital structure that you see in front of your screen. Now Facebook is 100% equity, so there the weighted average cost of capital should be 20%, right? Because all equity. And what should be the Apple? Let's say if it's 90% and 10%. So it should be slightly lower than 20%, right? So 90% into 20 is 18 plus 1%. So it should be 19%, right? Not 20%, correct? And there is another one which is, let's say 50-50. So 50%, 20%, 50%, 10%. How much should be the weighted average cost of capital? 10 plus 5, 15%, right? So in this case, all the three companies will have a different weighted average cost of capital, correct? But that is the superficial point of view, that calculations, it seems like weighted average cost of capital should be different for each company, right? Because of the different weights. Am I right? There is a theory by some renowned finance professionals. They have got Nobel Prize also, unfortunately. Their theory says that weighted average cost of capital does not change. It's not dependent on the capital structure of the company. It's dependent on the inherent risk in the market, not in the company itself also. So the weighted average cost of capital is not going to be changed despite the change in the capital structure, because when you have debt, risk in company increase. So equity shareholder want to get a higher return. So whatever is company saving, let's say the weighted average cost of capital for a telecom company is 20%. If Apple decides that I want to take 10% debt, right? By using this theory, weighted average cost of capital of 20% and debt is only at 10%. So the equity shareholder will increase their expectations automatically because you are introducing debt. My saying is that if, let's say, all the three companies are working in the same industry, Facebook, Apple and United Intercontinental, right? We determine that all the three companies use different type of capital structure. Their weighted average cost of capital should be different, correct? But as per the renowned theorist in finance, the capital structure does not define the weighted average cost of capital. I mean the risk in the company. The weighted average cost of capital will remain same. You increase the debt or you don't increase the debt. You have is 100% equity or you have it some part with the debt, some part with the equity. So what that means is that because if you introduce debt, right, you normally will reduce the weighted average cost of capital ideally, correct, by using the formula. Am I right? But the theorist says that because you introduce debt into the company, the equity shareholder will feel it's a bit of high risk, slightly higher risk. So they will start to expect a higher return from the company. So the weighted average cost of capital will remain same, is not going to be changed. The more debt you increase in the company, the more equity returns will expect from the company. The shareholders will expect higher return from the company. So you cannot reduce your weighted average cost of capital but just by adding more debt into the company. So the weighted average cost of capital is independent from the capital structures, but you can calculate your weighted average cost of capital using your weights. Okay, so there are two contradictory components of it. So we calculate weighted average cost of capital by looking at the average weight of equity, average weight of debt, right? Average weight of debt and average cost of debt is clear, is everybody know. Average weight of the equity is everybody know, you can calculate easily. The expected return on equity is something you don't know, right? You have to estimate that, and that estimation comes from the theory that your weighted average cost of capital will remain same throughout your industry, no matter what is your capital structure. So means you can look at the industry in general, what is the expected return from the shareholders, and you can follow the same. If your company has higher debt, means the equity shareholders will expect a much higher return in the project, while compared to a company which is 100% equity. You can still ask me if still confused with the WACC, with the capital structure, so don't worry about that. You will still have some chances to get it explained automatically. So let's move forward and let's look at the weighted average cost of capital. So there are two types of capital structure. When we use the debt, we call it leverage. There are certain unlevered firms which don't use any debt, they always use only equity, right? So they use only equity, and the weighted average cost of capital in the unlevered firm is equal to the cost of capital itself because there is no debt. There are levered firm. Levered firm means they use a mix of equity and debt. So their weighted average cost of capital is equal to this formula, RWACC equals to the fraction of firm value to finance multiplied by equity cost of capital plus fraction of firm value financed by the debt cost of capital equals to the total asset cost of capital or average cost of capital, WACC. Okay, now when you are evaluating a project, you sometimes are asked to calculate unlevered ROI, IRR and levered IRR. So what that mean basically is there are two ways to finance a project. One is you do it by equity only, means your own money, and another way is to take debt from the company. So when you are using only equity, that is called unlevered. The unlevered IRR means you have no debt into it. And then there's another one which is called the levered IRR, which is you use a debt as well. So I mean, if you minus the interest from the project cash flows, that will give you unlevered IRR, means just only for equity purposes. And if you don't reduce the interest part of from the free cash flows, that will give you the levered IRR, means it includes the debt, and usually it's lower than the unlevered IRR. There is a problem. Just to get you some calculator exercise, let's say you have a debt on your balance sheet. You have a face value of your debt at $10 million. It's trading at 95% of face value, means in the market value of debt is 9.5 million. It also have a debt equal book value of equity of $10 million. $1 million at the stock at the market price of $30. So means they had total is $30 million. So what is the weights that will be used in calculating the WACC? So you have to calculate that. So the total value of the company is 9.5 plus 30 million, that is called $39 million, right? And then the debt is 24% and equity is 75.9%. Even though both in book value are at 50-50%, means when they started the firm they were at 10%, 50% and 50%, but now at this current point of time they are 24% and 76%. Now the next topic that we have to discuss is the firm's cost of debt and equity capital, how we determine the cost of debt and cost of equity. So for that we have to use the something called yield to maturity and the cost of debt. So we discussed last time, I think, yield to maturity when we were doing the bond calculation. To calculate yield to maturity, like the total interest divided by the market value of the debt as a receive to payment, and at that value where the NPV is the same. That's how we calculate the yield to maturity. So we can use this yield to maturity if they hold a debt and receive all the payments as promised. So we can use these as a yield to maturity. But since the debt is a P&L item, the interest is a P&L item, normally there are tax savings. If you pay interest, you get to reduce your tax payments. If you pay dividend to equity, there is no tax deduction because you always pay this out of the net profits after taxes, right? After paying the tax, whatever is left you pay as a dividend. So there is no tax saving on paying the money to equity. But interest is part of your operating expenses and there is a tax saving on the interest part. So that's why normally the effective cost of debt is always the rate of interest 1 minus the tax rate, because you always have a tax saving. So that's called the tax shield. We always are able to save money by the tax shield, corporate tax rate. So if you take an example, let's say the General Electric yield to maturity for a debt is 1.98%. If the General Electric is paying a tax of 35%, what would be the effective cost of debt? So the effective cost of debt will be 1.98 multiplied by 1 minus 0.35, i.e. the tax saving. So that will become to 0.01287 or 1.287%. Even though they pay $1.98 per 100 to the debt holder, actual cost to the company is only 1.287, because 35% of that 1.98 they are able to reduce their tax liability. So now you can say, oh, my firm is in a loss, I don't have any tax savings, should I use the full amount or not? Theoretically no, but practically yes. So practically you have to see, are you really able to make savings or not in terms of the interest. If you are already under loss, right, and you think in the future also you will not be able to use the interest as a tax exemption or a tax deduction, then you always need to use your pre-tax interest rate as your cost of debt. Cost of preferred stock capital. Usually cost of preferred stock capital is also very simple, because you are paying a preferred dividend, a fixed amount of dividend, divide by the stock price. So it's simple, right? The number of percentage. Let's say that in General Electric Series D, preferred stock has a price of $85 and an annual dividend you have to pay is 3.5. So the cost of preferred stock is simple, 4.08%, right? Then you calculate the cost of common stock capital, i.e. your own investment, shareholders money, proprietors money, partners money, or however you want to say it. That is the most difficult to calculate because you don't have any benchmark. For that we use something called capital asset pricing model. Now what the capital asset pricing model is says that if, let's say, your company is working in the same industry as S&P 500, because S&P 500 take care of almost all the industries. So normally you have to calculate the beta of the firm or a similar firm in the same industry by using the last 60 months returns in the S&P 500 as a proxy, and then you determine the risk-free rate, that is usually your treasury bill rate, and then you must estimate the market risk premium, how much premium you want to charge based on risk in the market. Or you can also look at historical returns of the S&P 500 over from the risk-free rates. So you will be able to gauge how much is you want to charge. If you remember in the chart that we show few minutes back, where we were seeing the average return from 1925 to 2015 of various things, right? Treasury bill, corporate bonds, S&P 500, world index, and also these small stocks. So you can use S&P 500 as a benchmark for your normal returns and calculate the risk premium, and then apply the CAPM formula. So the CAPM formula is cost of equity equals to the risk-free rate, which is your treasury bill rate, or you can say your government interest rate, plus equity beta into market risk premium, right? Now this is just a theory part. We will explain the practical part of it. If you look at the formula very closely, right, there are few estimates that you have to make. The risk-free rate comes as a fact because you don't have to estimate that. That is available in the market by government offering you the loan or bank offering you the saving bank interest or a fixed deposit interest, right? So there is normally a saving bank interest is the nearest of the treasury bill because they offer a very small, because the risk is not there. You have insurance to your saving banks as well, right? So the risk-free rate is easy to calculate. Now the question to calculate is the equity beta. What is your beta? How your company will behave in relation with the others, and also the market risk premium, what benchmark you use. So if you are using any kind of different estimate, there are different ways different companies use to calculate this to understand their cost of equity. So we will look at the individual part of it, but let's just to give you a slight practice. Let's say the equity beta of General Electric is 1.3. Now what is the meaning of beta? The beta means what is the relationship between the company performance and stock performance. Let's say the General Electric, the meaning 1.3 beta means that if market increase by 10%, the General Electric will increase by 10 into 1.3%. So they will increase by 13%. If market drop by 10%, the share price of general market will also drop by 10 into 1.3 or 13%. So it's a relativity index. The beta can be negative also, which means that if the share price of general market goes up, the price of General Electric will go down. If the price of general market go down, the price of General Electric will go higher. So that's an inverse relationship. So the beta will tell us what is the relationship between the company and also the stock market, right? So you have to use the plus beta, positive beta, to say what is the relationship between the market, multiply by the risk premium. We have to estimate what is the risk premium. So let's assume it's 6%. So the General Electric cost of equity will be 3%, which is risk-free rate 3%, plus the beta into market risk premium. So it will be 10.8%.